I always do start off the week, with a summary of what we saw happening this week. And so we'll go to our chart. For those of you who've been watching the show, you know this chart. We've been pulling it up for over a year, basically. And so this is, the beginning of this chart was the high, right? Roughly 4,800 and change on the S&P 500. And then we had all of these giant run-ups, but they kept falling all last year up until October. And turned out October was the low, and the market climbed a wall of worry, right? I mean, Wall Street was expecting really a majority of what I read anyway seemed to be 20-30% farther down. And the reason was because when you raise rates the way that the Federal Reserve is raising rates, it causes all kinds of economic problems. And usually something breaks. And so 2008, we saw Bear Stearns and Lehman Brothers and such, go out of business. Bear Stearns gets bailed out. Lehman Brothers doesn't. The market dropped 30%. And so this time we had that happen. And actually Silicon Valley Bank and Signature Bank, First Republic, right? All these regional banks almost went out of business, or did go out of business, but it almost caused that big Lehman Brothers moment. And I think it would have. The difference was that, the U.S. at that time didn't bail out Lehman Brothers, and they didn't actually bail out these banks. They just stood behind the depositors. And they set up an institution to allow the banks to borrow against the full value of their high-quality bonds, and that allowed them to kind of cover this gap, because the bond market had, last year in 2022, the 10-year Treasury had its worst year since 1783.
Yeah, I think the bond market is... at least for treasuries, it's going to be the third year in a row. It's on pace for a third-year row decline, which hasn't happened in 250 years.
Yeah, and that's tough on the banks, because that's one of the places that they put money, and so if they have money in that, banking system deposits, they might put some of it in bonds. They have to have a certain amount of capital on hand. And the newish rules are that they have to mark to market, which just means that they have to, they used to be able to just say it's $1,000 bond when it comes due, and that's what they put on the books. And then their capital, it could drop to 700. It didn't matter. Well, they changed that. And so all of a sudden it dropped 700. They have to make up that differential in capital. And that, Silicon Valley Bank kind of started this. They were going to try to make up that capital by, sending out new shares, right? And that just alerted people, and boom,
spooked the market, and they were gone.
Yeah, and so was several other banks. So, but if you look at this closely, kind of the point this year where we got back to that blue line and kind of challenged that was the point where Silicon Valley Bank went out of business, and we've had this phenomenal run up. And so again, one of my thought processes going forward here has got to be, you have to take a look at what the government's going to do anywhere in any country, because this is becoming a thing. And so China, for the month of August, the first 3 weeks here, really we saw big downturn, and now we've seen this really run up, and it's almost got us all the way back to where we started. And a lot of the talk was, hey, this is falling because of worries of China, and there's a lot going on there that I think is important, especially in their commercial property segment. But there's all week and the last couple of weeks, lots of different new stimulus programs and rate cuts and things that they're trying to do. I think they're a big enough country. Everybody sees the pattern on how to do these things. I would be surprised if it's as big a problem as people think. Basically, the only way it can become a big problem is if China somehow can't do or won't do the types of bailouts that need to. And that's what happened in the U.S. We decided not to bail out Lehman Brothers, didn't realize that it was kind of a house of cards. And that's why they're kind of doing these bailouts now, because I think it was like $7 trillion of cost that ended up, for all the bailouts that came to bail the whole country out versus the $150 billion that was needed to bail out Lehman, right? So this is just some of the history so you kind of understand what's going on. And the market's doing, I think, fantastic this year. We're up, 19%. It's a really good year altogether. We're in a bull market now on an official basis. We're setting new highs that are higher than the previous highs. All the lows that we set are higher than the previous lows. Everything we look at from a classical standpoint for an up market, the 200-day moving average is higher than the 50-day moving average is higher than the 200-day moving average, et cetera. So that's still intact. We talked about, 5-6 weeks ago, the need for a consolidation period. right? It's going too fast, it's pulling too hard. And I really like when it has a consolidation period, because if it really, really pulls and it keeps going another 5, 10, 15%, then sometimes the pullback is so severe, it freaks everybody out. And that's why you get these much bigger downturns. And so this, if you look, the downturn we had here in August is just like the other downturns we've had going all the way up through here. And so things are completely normal so far. Now, they might attach some news to it, whatever that is, but altogether, this is actually a pretty big week. It was a good week for the market, but there was a lot of things reported. And I'll start with one piece, though, to kind of show you what I think is important right now, and that's technology. Big technology is running. And so this is from May 12th. We bought QQQ on May 12th in our portfolio, and I'm cherry picking here. You know, not all of our purchases work out this well, but I just want to make a point here that, first of all, big technology, it's hard to see these numbers, but up 15.9% for QQQ in the same time period. The S&P 500 is up 9.2. That's a big differential in a fairly short period of time. And I believe that this differential has some room to go, right? Because we have 175 ETFs in our universe, and we look at those. We have different time periods where we're doing a look back, how far back are we looking, and we have kind of a line in the sand, so to speak. So when one of those holdings like QQQ that we have falls below that line, you know, we'll sell it and buy something else. And right now, if you look at that, it's still bubbling up. Now, here's what's really important to understand. Think about May 12th when we bought this. The country was supposedly going to run out of money on June 2nd at that time. They ended up extending that, I think, to June 5th or what have you. But we were in the middle of a debt ceiling argument. I'm getting calls from clients that are worried about what's going to happen, rightfully so. And here we are. We bought QQQ in that time frame, and we actually bought a lot of technology in that time frame, because you have to take a look at what the market is telling you. You can't just focus on the predictions and you know, what Warren Buffett's doing, or, you know, what the news is saying and what Wall Street is saying. And Wall Street's, you know, at that time, things are going to fall apart. You can't pay too much attention to what's happening, even in the political arena in this particular case. The markets will tell you this week, the markets were doing really well heading into some unknown numbers, right? The PCE, which we'll talk about in a minute, inflation number was coming out on Thursday. The big jobs report was coming out today, this morning. The market's going up. And I said on the Tuesday video that I do on a daily basis, I said, look, the market is going up right now. Let's see if the market is right about these reports. And it mostly is. And my thought process with the market has always been that there are people out there that know what's coming. Right? Once in a while, you can see the market get surprised. But if you just pay attention to what the market is saying, and I'm not saying that like everybody knows what they shouldn't know, like insider type information, you know, these government reports. What does happen is that there is huge money. I mean, big trillions of dollars in the market. And some of these big firms have enough resources to kind of put together those government reports.
They can kind of make their own analysis.
Before it comes out. And so that's what you watch for. And so here, technology's popping along in the middle of the debt ceiling argument. And it's worked out great, right? And why was it popping along in the debt ceiling argument? I think partly, at least at the beginning, it was because people were looking for these big companies with big cash flow. If we did have a debt default, maybe the Apples and Microsofts and what have you of the world, you know, survive those better because they have, you know, such huge cash flow, name recognition, and what have you. Eventually, this will morph off into something else that's running, you know, smaller stocks, a value stock, I don't know what it is. But right now, technology's running. We're running with it. I would stick with that for a bit here because we're still seeing that as the piece
you want to
that's
ride the wave
bubbling
to
up.
the end.
Yeah, I think that wave is not just beginning, but it's still rolling. It's still pretty strong. And now, what you will see, if you look really closely at that chart, during the down period time there, you'll notice that the orange line, which is the QQQ, gets a little bit closer to the S&P 500 because it's a bit more aggressive, right? So in the down market, it's coming down a little bit faster, but we're in an up market. right? We're in a defined up market. And so that's when you can be a little bit more aggressive. And you got, this is just our target pieces. Most of our money is in these big core things like the S&P 500 and total stock market type indexes. But this is where we kind of make the money on the margins, make up for our fees and hopefully then some, right? And this is where that comes from. So let's take a quick look at kind of what happened this week, because there was a lot of great reports this week that I thought were really important, because the number one threat, in my opinion, just in my opinion, is not China and it's not a recession. It is a reinflation of inflation, bringing that bubble back up. And you can actually tell that that's the number one threat for the market also. Maybe China's in there too, but because every time we got a report that showed something where things were slowing down, the market went up.
Yep.
If everybody's worried about recession, the market doesn't like to see things slowing down. If everybody's worried about inflation, the market likes to see things slowing down. So here is the number of job openings over the last 3 years. It came down for the month, a fair amount, but it's still at 8.8 million open jobs, right? And if we look at that long term, go back to say, the beginning of 2000, we're still pretty high.
Yeah.
So to me, that's like the perfect report. You want to see that continue to come down, because bad news in inflationary timeframes is good news, right, for the stock market up to a certain point.
Yep.
If all of a sudden we're way below average, if you look back at 2010, see the number of job openings, the stock market was falling apart back then, right? And so, you don't, and we were in recession, all those things. You don't want it to come too far down, and who knows, maybe this will all go all the way down there. But at the moment, the wave has got to be to the upside, because there's still plenty of jobs opening, but the trend is down. And what that does is it just lightens up the pressure on the job market, and it lightens up the pressure on the Fed to raise rates, and all of this comes back to the Fed, right? It's funny to me, because I lots of conversations with clients about who's going to be president or Congress or what they're doing, and other than the debt ceiling arguments, honestly, I don't know that it has a massive impact on the overall stock market. The Federal Reserve is the person that I spent, the chairman.
The Fed's looking for a normal labor market.
Yes, yeah, and exactly. And so that came out on Tuesday. That's a pretty good report, in my opinion. That's perfect. And then we had the ADP. This is the how many new jobs were created. ADP is a payroll service company. And so how many new signups did they have inside their existing base of clients? These are private companies, and these are sometimes smaller companies also. So 177,000 jobs, 200,000 was expected. So that was seen as a good thing. Market kind of popped on that. But again, if you look at that, going back, now it's kind of more in that norm range. It's not real hot, but it's not super cold either. So again, this is part of right at the moment, this soft landing that we're coming in on. And then we had the core PCE index, and I won't bore you with a lot of things here, but this is a really important number. This PCE is the personal consumption expenditure. We've talked about it many times. This is the number that the Federal Reserve is looking at, trying to get this down to 2%. It's not CPI, it's not headline, it is core PCE. And so if you look, it's still at 4.24%.
It went up from previous month.
And it went up from previous year over year,
There you go.
right? And so, but one of the things you got to be careful of is when you're doing a year-over-year comparison, sometimes you get a weird anomaly the previous year that creates that differential. And so sometimes it's better to look at that month-over-month. So here's month-over-month. And, sorry, I didn't put it in there, but month-over-month was 0.2%,
Yep.
same as the previous month. That's the best 2-month run we've had in PCE core inflation since 21, since early 21. If you look way back on this chart, early 21, inflation was low. Year over year was a 1 point something percent. And if you annualize those 2 months, you'll be at 2.4%.
Which is pretty much where the Fed wants to be.
Yeah, pretty close. Matter of fact, with a little bit fall in between now and next year, you could get to 2%, something next summer type of thing. So we're heading in the right direction. Now, it is, problematic to take 2 months and annualize it out, right? But it's the right trend. It's what we're looking for. It's what the Federal Reserve is looking for. And this again, all of these things that came out this week are going to take pressure off of the Fed.
And the Fed's basically, the market's looking, is the Fed going to raise rates?
Yeah,
that's their big concern.
Right, exactly. And because historically, the Fed has over-raised rates. and broken something that couldn't be fixed, and we've ended up in a recession, and some of them have been quite big, and that's what people are worried about. That's it. That's what it comes down to. And so 2008, we had 21 rate increases because of the housing situation, the craziness in the loans that were going on there, and they broke the whole, housing market. And then 2000, we had this irrational exuberance that was happening, and money was being pulled back, and rates were increased 19 times, and we ended up with a 45% drop. 2008 with a 57% drop. Both those times you can make a pretty strong argument that the Fed went too far with their rate increases, and they broke something. So that's what everybody's worried about, rightfully so. So that's why we look at these numbers and say, okay, what's going to happen here, and how's this going to play out? And so here's another one that came out. This was this morning. This is, non-farm payrolls. This is the Department of Labor. This is the big jobs report that comes out that everybody cares about. It was at 187,000 jobs. I believe the consensus estimate was around 177,000.
Yeah, so it's a little bit above, but then they revised previous months down, which kind of...
Yeah, it was just kind of amazing because they actually revised them down like 110,000 jobs. That's a lot. I mean, on a percentage basis, these reports aren't even close to being accurate until later, apparently, because that's not unusual. I keep seeing that. But that's exactly right, because one of the things that, again, if there's too many jobs being created, that means that there is too much pressure in the economy that can create inflation, and that means the Fed starts raising rates, and they can do it too far, and they can break. And so, but if you look at this long term, 187, that's a pretty good number.
Yeah, you want your job market to be constantly growing.
Right. Yep.
And the nice thing is when you look at this, there wasn't very much wage increase. There's only 0.2 for the month over month.
That's right. I've got hourly earnings, so 0.2% increase month over month, year over year, 4.29. Yep. But I just wanted to kind of show the trend too. See if you see that, overall trend, the hourly wage is actually coming down. Now, again, if you're a worker or if you care about workers, you want to see it go the opposite direction. If you're an investor and you're in a high inflationary period, you'd like to see this trend. You'd like to see a softening of that back down to something normal. If you look prior to the pandemic, sorry, that's not in here, but the 4%, 3.6, that's kind of a norm. That's usually where it sits. So we're getting closer to there. And as Eason mentioned, it actually went up 0.2% for the month, which again, analyzing that out is 2.4%. The market likes this, and the Fed's going to see these same things. And so that's came out this morning as part of the report. And then just the last piece is the labor force participation. And so this is going back, I did 5 years on this, so you can see what happened to the pandemic, right? A massive drop off as everybody was laid off, but not really fast coming back. Right? But we did have a nice pop here last month, getting back to 62.8%, which is the highest labor force participation rate we've had since February of 2020. So just before like the lockdowns happened. And so what's really important about this is you have high inflation. Most of it is in the service industries. Service takes labor for the most part. And you need more people to be working in order to bring down the prices, the increase in prices on services. If you've got lots of waiters and cooks and what have you in your restaurant, you don't have to restrict the supply. If everybody's lined up around the block, they won't be because you have enough people now, right? And so this is a big deal too. There's a lot of good things that happened this week. And the market really hopped over the last, 10 days or so. And again, all these reports are pretty good. I think the market kind of knows, somebody knows, the majority, the big money knows. And you can kind of follow along with the big money by just watching what the market, instead of watching the news so much and the projections from Wall Street and what Warren Buffett's doing or what have you, just keep watching what the market itself is doing. And at the moment, it's telling us things are okay, right? That can change, but it has been all year. So that's our report for the week.
What were the signals for the ending signals for the week?
Oh yeah, let's talk about the signals real quick too. Forgot about that. So for the stock market signals, we have green for the fast signal. So that means for our kind of our IRA type assets,
Yeah.
things where we don't have to worry about taxes, which we're not, and we don't have a transaction cost on these ETFs either, so we don't have to worry about those. That's a faster signal. It'll move from green to red to yellow faster, and so that basically denotes a big piece of our practice. We have a lot of money in retirement plans, and then yellow is more the taxable accounts. We tend to take that a little slower. We don't want to make as many transactions, and that signal moves slower. It's not too far from green. Right now, I was just looking at it this morning, and so I wouldn't be surprised if next week or what have you, if the market can just hold up here some, that we don't get to green on that. And then the bond signals, again, we're at green on the short-term signals, again, that we would use for those retirement type accounts, and still at red because the bond market has been really kind of waffling for the year, as you mentioned earlier. So, but that's getting better because it was red.
Yeah.
Just last week before. So that's hopefully going to come around. The bond market should be doing better because of the fact that the Federal Reserve is going to have less pressure to raise rates.
Yeah.
But it's still struggling. I think partly because they have to make up for they have to make up the money that they couldn't get during the debt ceiling argument. From February to June, they couldn't issue new bonds. They're still making up that. And the other thing, of course, the Federal Reserve purchased bonds on the open market called quantitative easing, right, during the pandemic to kind of create liquidity for the overall world, really, but for the market. And then now they're doing quantitative tightening. They're actually letting those bonds fall off, and they're selling some of their bonds also. That creates some pressure on the bond market, and that's going to go on for a while too. So that's why the bond market doesn't have the same upward pattern that we're seeing in the stock market. I do think there's going to be some opportunity there at some point here because the yields have gotten so competitive.
Yep.
Yeah. So anyway, that's our summary for the week. Look forward to being able to see you again next week, and we'll talk about it then too. So thank you very much. And